let's bring in Art Hogan, National Chief Market Strategist. And Art, you just heard Brian kind of break down his read on the bond markets. I'm looking at the 10-year yield right now at 1.43. We've also seen the 30-year yield move too. What does that tell you about the expectation in the market?
Yeah, I think Brian did a great job of breaking this down and talking about the spread between the 2s and the 10s. But the way we look at that really is the 2s tend to be a reflection of where we suspect monetary policy is going. And the 10s tend to be a reflection of what we think the pace of economic activity is. So that's why that's tightening right now. We suspect the Fed is likely going to pull, with their summary of economic projections and their dot plots, going to pull some of those rate hikes that were sitting in 23, the last time we got to see a fresh dot plot, into 22, right? So that moves the 2-year, the front end of the curve up, while we also suspect that there's going to be some modicum of economic slowdown because of the Omicron variant and the things that we're hearing about it. So, much more contagious, but likely much less virulent. So I think that we're concerned about the pace of economic growth going forward. At the very same time, we know we've got a tightening in front of us. So, to Brian's point, the Fed's got to walk a fine line here to deliver the message that says, here's what we're thinking about monetary policy. We think we're going to taper a little more aggressively. We'll take that $15 billion a month to something like 25 or 30, and that'll shorten the time period with which it takes to get to the end of that process. And I certainly think they're going to lean into the fact that, hey, it looks as though we're pulling a couple of those dots into 22, so that'll signal that the Fed sees a couple of interest rate hikes this coming year. That'd be different than the last time we had a SEP or some economic projections. And I think that balancing act is what Jay Powell really needs to navigate, especially as he works his way through the presser, because it's going to be all of a sudden, hey, did you get this wrong? Are you behind the curve? Do you have to hurry up the pace? And clearly, they've already admitted that, right? They're going to taper faster and likely still keep some separation between the end of the taper and the first rate increase, but that happens sooner than we had consensus estimates for 2 weeks ago.
Yeah, and Art, I mean, when we look at maybe how the market's been reacting to all this too, right? Technology, once again, taking it on the chin today, whether you're looking at the NASDAQ or just kind of the sector action we're seeing in the S&P 500. Adobe, one of the biggest losers there too, and they're reporting earnings later in the week. I wonder how much of that is tied to maybe the rate expectations there, what it means for growth names, or maybe if we're just seeing some profit taking at year end. Obviously, always kind of tough to tease this out, but what's maybe the takeaway for investors as they ramp up and look to allocate in 2022?
Yeah, Zach, and it's such a great question. And when you think about technology, we've got the Nasdaq Composite, which is only about 5% off its all-time highs, right? But if you lift up the hood a little bit and look at the average stock in the Nasdaq Composite is almost 40% from its all-time highs. And that just is an expression of just how much growth has been re-rated lower. And what happens when you have an anticipation of higher interest rates, growth stocks or long-duration growth stocks certainly get hit the hardest. So when you do that net present value calculation with a higher interest rate, that implied multiple or ascribed multiple to growth names comes in. So a lot of that's been priced in. When you think about some of those real growthy names and momentum names and risk assets, they've seen a lot of carnage, and that's been happening since the peak in November. So I think that what the market's trying to tell us here is that when you set your asset allocation plan for next year and you want to have a barbell approach with growth on one side, you want to have those growth names that are actually valued at a multiple to earnings, not a multiple to revenues or a multiple to cash flows or a multiple to sales. And that's the problem. The multiple to sales and multiple to revenue names are going to continue under pressure until we get to that terminal rate of where the Fed stops raising rates. And the market's gotten way out in front of that right now. And there's been a lot of damage in a lot of those growthy names.
Let's talk a bit more, Art, about what that allocation should look like. You've obviously highlighted the importance of diversification, especially in the face of uncertainty around Fed policy. You've talked about the growth names. So what are some other sectors do you think investors should be adding exposure to right now that offer particularly good value?
Well, we anticipate 2022 is going to be very much like 2021, where you really want to have a balance between growth and value. And as I mentioned, you want that growth to be an expression of thematics like 5G and cloud computing and cloud security, but you want those expressions to be in a PE, not a price to sales type name. So you more traditional of your growth names in place. On the other side of that, we really think the economically sensitive cyclicals are going to do very well. We think that the two sectors that are most economically sensitive and cyclical that should be on the other side of your barbell clearly fall into the energy and financials. And I think both sectors have a lot of runway in front of them. But what's important is with all of the rotations we see throughout the course of the year, you want to make sure you keep that barbell balanced. You want to make sure every couple of months you're looking at this and saying, am I still balanced between both growth and cyclicality? And if you do that, you outperform the S&P 500 this year, and I think you'll do it again next year. And it's diversified, but it's also rebalancing on a regular basis.
Art Hogan, National Chief Market Strategist, joining us there. Appreciate you taking the time once again, sir. Hope to chat soon.